This is the Collecting Real Estate Podcast. I'm your host, Stephen Pearse, here with your co-host, Bill Hamel.
I'm somewhat more comfortable collecting real estate than I am collecting other stuff.
This is the Collecting Real Estate Podcast. I'm your host, Stephen Pearse, here with your co-host, Bill Hamel. We're doing something a little different today for the 100th episode, going off script. It'll be the two of us today, mostly discussing repositioning multifamily assets. That is the core of what we do here, right, Bill?
That is what we do, Stephen, and we can do this with real live assets. We've both done some deals this year. We're repositioning multifamily properties, and we have a lot to share. We'll do an abbreviated description of some of our trials and tribulations today, but we're both operating these assets right now.
Yeah, there's a lot of talk about finding the deal, financing the deal, structuring the deal, managing the asset, and all of that is extremely important. But all of that can be tied into repositioning multifamily assets. Those are the different steps it takes in order to reposition a multifamily asset, and that's the business model that we use.
That sums it up. And with that said, I'm doing an A to Z description of finding the asset right to operating the asset on a property I just got into in St. Petersburg. But I'd like to talk to you to start this up with your big purchase that you made a few months ago, because you're right in the middle of it, and it's a fantastic property, fantastic location, but there is a lot of work to reposition an asset with problems.
Yeah, and we often hear the problems are where you make money, and it sounds easy when someone says it, but in the day-to-day, it's been very difficult. Like you said, it's a great building and a great location with some problems, and a lot of that is a lack of management over the last couple of decades, and we needed to go in there and redo the common areas, turn over some units, and get an increased NOI from where the property was operating beforehand. It's my first time doing lifts that heavy, so there's been a lot of learning involved. Out of the 24 units, we're expecting to turn over half by October. So a lot of learning in that construction and maintenance side of the business.
Yeah, and let's get right into that. Now, I'm so focused on that A to Z journey here. Tell us how you found that deal and how you financed that deal, and we'll rock and roll from there.
So the deal was found from a friend in the industry. We were having a catch-up call talking about what we were both working on. He mentioned this property being something that he had a offer accepted on. And as soon as he mentioned it, it really caught my attention because that's exactly what I'd been looking for without really looking for. That's something that if I had anyone tell me about this property, I would have been very excited because it's in the town I grew up in. It's a brick building. I like brick buildings. It's in a great location. It's a manageable size of 24 units, which would have been scaling up for me, but not impossible, not too overwhelming. So everything about it really fit the criteria that I like. And I asked if he would assign the contract to me. He didn't want to at first, but after a little bit of back and forth, he was finally willing to assign the contract. And the difficult part about that, and I've talked about this before, but the difficult part was I only had about 2 weeks to close on the property.
Mm.
So I had to find financing with 2 weeks, and that doesn't give you time for appraisals and surveys and environmentals and all the typical due diligence items.
Yes, I love that. So you found that deal based on a relationship. We love that. That's where it all begins, or a lot of the times that's where it all begins. And not only was it relationship based, you had to do I guess you can say aggressive follow up. If you just took no for an answer, you wouldn't have owned this 24 units. So you had to follow up multiple times with this gentleman, make him think, and ultimately he's like, sure, I can make some money. You can take on this asset. He's got a lot going on, and you were able to grab a 24 unit literally in the neighborhood you grew up in. What I really loved about that when you brought me over there, it fits that how a property is situated. You have this 24 unit, beautiful brick structure in the middle of this single family neighborhood. I love that.
Yeah, it's brick structure, single family homes around it, and then the back of it backs up to a park. So from every angle,
Mm.
it's a perfect setup. You would never get zoning for this anymore. It's built for military housing in the 50s. And I saw the problems walking around. You see the spider webs in the hallways, you see the galvanized plumbing, you see the 80s carpets in all the common areas. So the numbers are running in your head for what it's going to cost to reposition this asset. But you know that the the parts that you can change, you can change the carpet, you can change the piping, the location, that's the important part. That can't be changed.
Mm.
So once you purchase this and you make that move, you can take the time to make those changes and reposition the asset. When I purchased it in June, the average rent was $965. We are currently redoing the full kitchen, full new soft close cabinets, top of the line, putting fans in bedrooms, porcelain tile in the bathroom, stainless appliances, redoing the plumbing so everything is new and modern. And for the larger units, we will be asking 1,500. We've already had some interest at that price, so that shows how far below market the rents were.
No doubt. And you bought arguably at market value. We're happy buying at market value as long as we're able to pro forma that where it's a value add deal, which it clearly is. You have to make the place look better and smell better based on, I can already smell that old carpet in the hallways. Even though I had never been in the hallways, I could imagine what that looked like and smelled like based on how you described that to me. And most importantly, it has that massive rent growth potential, being able to go from 945 to 1,500 on a 24 unit. Yeah, we'll buy market value all day long if we're able to get that type of rent growth.
That's why scale is important, because you that had that 500 rent growth, but you multiply that by 24 units, and that's massive. I love you say the smell. When you first get those 80s carpets, you have 40 years of cigarette smoke and dirt and dog
I'm
hair,
smelling it
but
now.
now we have fresh paint in there. And I've heard you mention the nice smell of construction and maintenance when you
Yeah.
have fresh paint and new flooring going in, and it smells new. It's like a new car smell. Everyone likes that. So I purchased that for
Jeez.
2.2, and it was 125,000 for the assignment contract. So 2.325 all in, and the plan is to have a value of 3.5 million by the spring.
And I'm sure you will. So, just to touch back into that repositioning a bit. On paper, as we all discuss with all the people that we network with nationwide, doing the same stuff we do, on paper, okay, we're putting a little money in, massive rent growth, and then there's going to be the value in a year or so. But let's get to the hard part here. Let's get to the challenges, which is taking over that property with that uncertainty of, okay, everybody's on month to month, or everybody has leases coming up, or a handful of people have leases coming up. So where do I do those lease renewals? If I'm conservative with the lease renewals, will I regret that if I get a huge tenant retention and you're not able to turn over as many as apartments as you'd like to get to that market rent? But if you're too aggressive on those lease renewals, you're worried about tenant flight, meaning out of 24 units, we don't want 15 people to move out over the next 3 or 4 months.
I like how you mentioned, on paper, we raise rents, we refi, and we move forward, and it's all so easy. And
Mm.
then you get into the reality of it, and it's not that easy. We were going to a conference a little over a month ago, and that conference was about how you reposition multifamily assets, and you refi and you cash out, and everyone makes money. And I, on the way to that conference, I got a text about one of the tenants at that property holding a tenant meeting, rallying together the troops and saying, let's stick it to this kid. And if no one pays rent, he won't be able to pay his bills, and then he'll lose the property. So there's been a lot of work trying to deal with these tenants. And your point of how conservative do you need to be on these increases? What influenced my decision making on this one was the fact that I only had a 1 year note for the private lender. That didn't allow me to be conservative. I had to aim for a tenant flight at that point in order to get the rents and the value to where I needed it to be. If this was a standard finance purchase, I would have been much more conservative. I would have raised the rents only, 10% instead of 30%, and kept raising them over 2 to 3 years with a 3 year refi projection. With only 1 year to refi this asset, I raised the rents considerably. So we had a 965 average. There's a smaller and larger unit there. I raised them to 1250 and 1300, which is still below market value. It's a large increase for these people, but it's still below market value, even for the condition they were in. And we had half the building decide to not pay and leave, essentially. So 12 of the 24 will be turned over the next couple of months. We've already started that process, but it's not easy. You have people who are very angry with you, and you have to go to that property almost daily to make sure things are going well. And it's uncomfortable. It's not the things that you usually hear about in the podcast and the books.
That's that's for sure. And this deal has been interesting for me to observe from the sidelines. I've been doing this a long time, and you would come to me, geez, 2, 3 times a week with a new update, with a new note from a tenant or a new event from a tenant or tenants. And wow, God bless you dealing with this so early in your real estate journey. I've never dealt with some of the issues you've dealt with.
Yeah, I've gotten some very aggressive threats. I've definitely learned some new insults. But like you said, dealing with it at this stage in the journey just prepares you for the next one. And once you've seen it once, it doesn't phase you the same way the next time. I, that's been difficult, but I'm comfortable and confident with management. It's been more of the maintenance that's been a learning curve for me. I have multiple different crews there who are skilled in different areas. And at the end of the day, the people leading those crews are looking to me to make choices on what to do there. And I don't always know what to do or what material is needed because I've never done it before. So I'm looking at them to, order the material or tell me what needs to go there. And they're looking at me to tell them what needs to go there. So that's been a lot of learning.
Yeah, and geez, you're not going to know right off the bat. You've never done anything at this level. I believe the properties that you've purchased up till now, they were basically running, other than another property that we'll discuss with each other shortly, where you have learned a bit from that, but that's been relatively light. You're dealing with, I believe, more of a moderate, in some cases, a little heavier of that value add. And yes, on that daily basis, making decisions of what to do with improvements from hallways to apartments, what building materials to do, how to measure what you're being charged for these improvements, project prices in relation to per hour based on the contractor. There's a lot of decisions to be made.
A lot. And again, once you do it once, it's easier the next time. You know what materials you use, you know what it costs. So you have that going into the next project. But the first time it's difficult. And you're also trying to manage the outcome, manage the delivery of what's being done in there. But they're not my crews. So there's often a middleman of someone running these crews. And there's a lot of dynamic pieces to turning over common areas and apartment units, especially when it's not your in-house team.
Yeah, and a little bit of what we discussed before jumping on today, it just came to mind as you're going through this process with your hallways and tenants moving out. You're going to have some tenants moving in, and I'm sure you've dealt with, the people that have given you the hardest time, maybe the ones that aren't paying rent. And then you may have some other tenants that don't give you a hard time. They're more understanding, and they appreciate the neighborhood they're living in, and they're working with you more. Has there been a communication stream that you've been able to keep with both sides, all the tenants, where everybody understands what's going on? Some staying, some going.
Yeah, there's a quarter of the units are great tenants. They're great to talk with. They're nice, as you say, normal people who are happy to live there, and they are appreciative of the improvements being done. The next quarter are a little on the fence, saying, "Yeah, I'll stay for now, but I'm not happy about the increase, and we'll see moving forward." And then there's that half who, if they do speak with me, it's usually aggressive, insulting, and nothing I would answer to, and that's in person and both online. So I think that breaks down the communication there. But at the
Yeah, no, I can see that. So next on getting back to the that rent roll. We love that rent roll because that allows us to plan our next moves on this property. So you've had a business plan at the beginning, but then the business plan completely changes based on how the tenants react. Who's staying, who's going. Okay, now I have a good feel of my turnovers. At that point, you're able to look at that rent roll knowing that you have half of your tenants moving out. Are you able to see how you're going to improve each one of those apartments as people move out over the next 5, 6 months? Are you able to pace it out so it's a little bit more comfortable for you cash flow wise? Or do you have a lot all at once coming at
A
you?
little bit of both. It's 3 or 4 units for the next 3 or 4 months, and somehow that'll average out to about 12, maybe 14 units over the next 4 months. And yeah, I'm kind of being very detailed every single day, running over the numbers of what's it going to cost per unit, how many
Mm,
are going to leave, what is that going to rent for, okay, what's the average rent if 12 leave, what's the average rent if 16 do leave and we do get the market rent, what if we don't get what we think we can get and we get a little bit below, what does the average rent look like at that point, okay, what does that NOI look like, okay, what if we get motion sensor light bulbs instead of all these light bulbs that are on 24/7 in the garages in the basement, how would that improve the NOI, and ultimately all of that is for that final outcome of being able to refinance in the spring. I did see a report yesterday that banks are hoping to get back close to the 4% range by next spring, which would be tremendous in order to refi
mm.
this. But I think that's a pretty full picture for that project and where we are now and what it takes to try and acquire the asset, how you're going to reposition it, the struggles involved, and eventually be able to refi out. I did refinance my 8 unit yesterday, so that was nice to get a proof of concept of I buy an asset for 667, I increase rents a little bit, and refi at a value of 920 in less than a year, and we get out of it more than my private investors invested. I pay them back, and now we have this 8 unit asset cash flowing for no money down. So that
Fantastic. 8 unit that you bought a year ago?
November 4th of 2021.
November 4th of 2021. So in well less than a year, you were able to make $250,000 of net worth.
Yes,
And now you're operating this 24 unit and you've been able to absorb all of the challenges till now. Now you have that business plan, who's moving out, what apartments you have to rent, how much money you have to put into the common areas in the apartments, underwrite that accordingly throughout the year. So you're able to see that pro forma leading up to that refi in early 2022.
that's the plan. And like any business, as you grow, parts do become easier because you have systems. Your accounting systems get better, your turnover systems get better. So once you have those in place, it's a little less of running around town, with papers in your car and acting like a madman trying to keep everything together, because that's been the daily life recently. But just starting to get everything organized now that we have everything in LLCs and we have these accounting systems in place. And next time there's a turnover, I'll say we have a 13 unit under contract right now that's going to be a syndication. I'm going to go in there. I'm going to measure the square footage of the common areas. I'm going to go into the units and get a count of how many cabinets we're going to need. I'm going to get people to look at the facade and get an estimate on that. So when we're going into this, we're going into the closing knowing, close to an exact dollar amount of what this capex is going to cost, because we have those costs. We've done it all before.
Getting granular, and that's so important. That allows you to really underwrite more accurately instead of just looking at something on a broad scale and then just I don't want to say guess, but putting a broad number without getting granular. You're not going to be accurate on that.
And we
So
both say, like, we know the numbers are right going into something. We know the numbers are good. We know enough to estimate and be, within that 10% margin of error, and we know that there's enough meat on the bone for that to be okay. And we know the numbers are okay, but it's so reassuring when you have the exact square footage of common area. You know what that laminate costs. You know what the install costs, and there's no room for doubt, especially when you're talking to investors and you say, these are the numbers, and this is what everything is exactly going to cost.
well, and also going back to the original part of the deal, you were able to act quickly on this. You had very little time to close, and you weren't able to put real accurate numbers. You only saw a couple apartments. You hadn't done a project this large before, but what you did know was this had such massive rent growth potential, you had to do this deal. And now you're a couple months in or so, and you've learned so much more. You've figured out where the rents are going to go. You figured out how many vacancies you're going to have, how much improvements are going to cost. And the beauty of that is now you can re-underwrite.
Yes.
Now you can say, here's where I am now. Now I can get granular on a lot of the details going forward and re-underwrite this and reproject where you'll be by year's end.
Exactly. And that's sort of where we are for the 15 unit in Troy, New York as well, Vandenberg Apartments. If you want to transition to that asset,
Yeah.
we almost completed that cycle of, raising rents, turning over units, redoing common areas, and repositioning that asset.
And that one we bought that, I believe, March 30th of this year. So we're only a half a year into this and ahead of schedule, because it's always so important to be conservative with that original underwriting, which we were. And we were able to handle this much differently than what you had to do on your 24. You need to race to refi because you have a more stringent loan product that you need to get out of on the 24. We were able to get very competitive financing on the 15 unit because it was fully occupied. It was operating on a healthy cash flow. We could have just bought this, did very modest rent increases, do hardly any work. The property was already running and it already would have cash flowed. But that's not taking advantage of the little bit of value add we can do and the massive rent growth. That's what we're doing this for. We want to maximize and optimize this asset specifically, not only for us, but we have investors.
Absolutely. There's a couple first points that come to mind. I'd say first, you mentioned about halfway through the year on this, and we're already ahead of year one projections, which is great. And again, that does come down to conservative underwriting. Two, this is another brick building surrounded by single family homes on the entrance, a long, nice driveway through single family homes. And on the other side of it is an area that's being redeveloped near a school that's growing. And again, it's an asset that's situated in a great location. So when you purchase it and it's already cash flowing, and the foundation's good, the building looks good, you know that over time, this thing is going to keep growing. It's going to keep appreciating. And it's an asset where the rents are going to keep rising and you'll be able to force that higher NOI. And then third, how much I appreciate having a manager on that building now that I'm the one that went in and was knocking on doors and raising rents on the 24. looking back at that, having management in place, it really does help you focus on the next deal instead of taking all of your effort and focus to manage the property. And there's so much value to that.
And no doubt, as a manager for over 25 years, I'm sitting out. Where's my phone? I'm sitting here. I no longer have to stare at that phone regularly throughout the day and night like a mental patient, wondering if someone has texted me or someone who's tried to call or left a voicemail on a emergency maintenance order or whatever that tenant was calling or texting about at that particular moment. So I don't miss that at
I don't leave
all.
my phone on silent anymore, and I can't stand it because I prefer to have my phone on silent, and I have to have the volume on in case something goes wrong. So I'm looking forward to the point where I can get management in place for my properties. I'm hoping this winter, early winter.
Awesome. So getting back to that 15 unit, and when we got into that, it didn't even fit my criteria. I wasn't looking for anything inside of the capital region's inner cities. I'm a town player at this point, looking for larger assets, 20 unit, 60 unit type thing. But when our deal finder brought us this deal, I was very familiar with the building because I've been driving around this area for many, many years as an investor. And that location across the street from the Hudson Valley Community College, I knew was such a strong rental market. I'm looking at that rent roll based on the unit counts, saying to myself, these rents look low. I have to take a look at this property. I walked through 2, 3, 4 apartments. They explained that all the units were the same exact floor plans. So one of those buying criteria that I have, or that full formula of buying criteria that I have
Yeah, I
had,
think that fit the full
is
formula. Do you want to quickly mention why you like the cookie cutter apartments?
I love that cookie cutter apartment because you're able to paint an apartment and now you know how much it's going to cost to paint every apartment. Same thing with the bathrooms are all the same, kitchens are all the same. Everything is the same. So once you do one, you're able to measure everything else. And on the revenue side, you're able to rent an apartment for $1,300. So there's your proof of concept. So now we know that we're going to be able to rent all the apartments for $1,300. And to kind of take it a step back through our operations on that 15 unit, we were able to approach our lease renewals much more conservatively because we had a very competitive loan and we wanted to make sure that we had stability. We didn't want tenant flight. We were able to take average rents from 935 or so and do those renewals at 1050 for great tenants. So we did get that decent rent bump. But also we had 2 vacant apartments that we created proof of concept. Very light turns, and then rented those first 2 apartments at 1250. At that point, we're like, yes, now we know what we're going to be able to rent all of these market apartments for. Now we're staring at that rent roll saying, okay, how many apartments can we turn over this year to get up to market rent?
And we're already ahead of that year one projection. And like you said, it makes it so much easier to underwrite when you know what the turnover is going to cost. You know what the market rent is, and then you have pictures, hopefully professional pictures of this unit, and the units all look the same. So it makes it even easier for marketing. If you have someone leaving at the 30th of the month, you can post pictures of the last unit you rented, get that new unit rented by the first of the month, and then use those last couple of days to do the improvements and turn it over and make it look like the pictures exactly like them because it's cookie cutter.
Yeah, another great point on those cookie cutter apartments. Yes, you take photos of that model apartment, and yes, now that we know, for example, someone is moving out at the end of October, let's get that thing on the rental market in September. So we've got 30, 45 days to fill that occupied apartment based on the model.
Something I was talking with Kevin about last week, shout out Kevin, he's our new director of acquisitions and marketing, he's doing a great job, was that whenever I've walked into a building, since I started doing with you, as soon as I've walked into that asset, I've either had a gut feeling of yes, I want to buy this, or no, I don't want to buy it. There's never really been on the bubble in between of, I don't really know if I like this. It's either yes, I really want this, or no, this isn't for me. Do you get that feeling too?
I've been getting that feeling for many, many, many years. And I think that you've observed that for me, where I'm not as aggressive as you are at this point. I've been there, done that. I've built the portfolio. I've sold off a lot of my portfolio. I've rebuilt it back with much larger assets. I feel like in this part of my journey, I can pick and choose what I want to get into. I'm only going to get into a deal if it's an absolute no brainer and I know that it's very, very straightforward to get to that from A to Z based on our projections. So I know that there's been a couple that you're like, all right, we just looked at this other property. The numbers look pretty good. The location's good. Let's continue to collect real estate. And I just wasn't feeling it.
Yeah, but there's one or two that come to mind when you say that, but I don't think we were in the position to do that anyway when that happened. So there hasn't been any that I was really pushing for and you were really holding back for. The ones that you were holding back, I think that was good where we needed some time to improve our own systems. But we're both so obsessed with this and we do it day in, day out, all day that I think we both run over the criteria in our heads so often that that's how you know when you walk into something because you obsess over your criteria and what that next one's going to look like. So when you walk into an asset, either it is that or it isn't.
No, absolutely. You're getting right back into that buy right criteria for me, and I think that you agreed to this. It's that location where the property's situated, what are the amenities, the floor plans, the building materials. We love floor plans that are very, very fluent and hardwood floors throughout, some granite countertops, massive rent growth. And we know that this particular location for anything that we're buying, as soon as it is prepared for rent, we know that there's going to be 20 people who want to rent this apartment and we're going to fill that within 30 days.
Exactly. We love townhouse style. We love brick. We love granite. We love hardwood. But speaking of good floor plans and a good situated property, well situated property, how about we discuss your large Shaker Latham, New York reposition?
Yeah, that one we waited for, myself and my brother waited for 3 years to get into that. So he had that relationship with a contractor friend of his. We had lunch 3 years ago, and at his age, he was definitely thinking of that exit. And 3 years go by, and he made that big decision to exit. We were the only buyers he was talking to. And when I walked through that last summer, it was basically a year ago, roughly, and the location is phenomenal. You're talking about an A location in the middle of Latham, New York, 10 minutes from my personal residence. It's an area that I've been doing business in for 20 years and had these townhouse apartments, 60 unit complex. And in this market with this massive rent growth, seeing the value add that it deserved, but that massive rent growth, we're looking at that average rent of 1050 for 2 bedroom, 1.5 bath townhouses in an A location. And we were conservative on the underwriting because that's what we do. Originally projecting 15 to 60, $1,600 rentals, and we're renting remodeled apartments for $1,800.
That's huge. It's almost an 80% increase there. 1050 to 1800, and you're not renting them all for 1800 because those are the remodeled turnovers. But eventually they'll all be at that price point, and what that does for the NOI is it almost doubles the value of the property.
Yeah, it's funny. We're going through the same process, asset after asset after asset. That's the beautiful part of this business. We have this template, and it's just a different address that we're doing the same exact action items. Different address, different rent roll. So we went in here, average rents at 1050. And we did all our renewals right up till now. We're at the tail end of our renewals for this property at $1,400. So the first 3 months, serious pushback. You have some long-time tenants that are, you're raising our rent 300 and something dollars. It's just a normal reaction, a very understandable reaction. And we forecasted 50% renewal retention. We're probably over 70% at this point.
Because you're still below market.
That's it. So I think, especially tenants at this level, a bit more on the sophisticated side, it only takes about a day to figure out that any other apartments that they're willing to live in this location, they're going to be paying $1,600 or more.
Yeah, because they're still below market, and that's the hard part about the Niskuna properties. I know most people are being forced to move to worse communities because even the increases I made are still below market, and there's definitely an ethical dilemma there of increasing people's rent and what that does to those families. But the other side of that coin is you're improving the community. You're putting new building materials into these different apartment buildings. You're redoing them, putting in nicer cabinets, putting in nicer appliances, and you're making this a nicer place to live for the long term. And you're taking care of the property and the community. And if that's the way you look at it, you really are helping people in the community in the long run. We Go ahead.
Absolutely. A tenant, any asset, if they're going to have an increased rent and get a nicer place to live, they're happy to pay that increase.
Absolutely. So you've been doing some repositioning on your own. I've been doing a little bit on my own. We have some together. My question for you is, how do you take this and scale it to that next level? Because we could both reposition one 20 to 60 unit asset at a time, do 2 a year, and live very comfortable lives, be very happy, fulfilled, all of that. But I've always wanted to be an entrepreneur, not a small business owner. We had Logan Rankin on the show recently. He went from 180 units to 1,900. That's massive scale. We're very involved with our projects right now, which is great. But what does it take to scale to that next level?
Getting people to help. And Logan, he runs his own property management company, but we know firsthand, and we've only talked to Logan once, but you know that he's not involved in the property management on a day-to-day. I would assume that he is meeting with his key employees once a week on the property management side. They game plan, and then the key employees orchestrate the business plan. And that goes with everything. You have to be the CEO of your business and let all your key employees take care of the work. And I think that's the key. And I just kind of big grin on my face where, boy, is that easier said than done.
Yeah, and if you listen to the episode, he really emphasizes the importance of people and culture, and that's what it comes down to. If you're going to be meeting with those upper managers once a week, you have to know that they have the same vision, the same goals, the same core values in mind, and they're implementing the culture that you've already created with them. And like you said, it's a lot easier to talk about than it is to do that.
Yeah, and you have to take it one step at a time. Chunking, the power of chunking, little by little. Are you able to, at this point, say, okay, I'm starting a property management company. I'm going to build this high quality maintenance staff to support that management company. No, it's a tall order. You have to take care of what's on your plate right now. So right now it's okay, let's just make sure that we get an effective third party manager to execute the business plan. So you are able to take care of some other opportunities as they present themselves. Now and we've discussed this, we've got a few different things that we're working on. And it's the challenge of being an entrepreneur. You're focused on your 24 unit right now, but you're also looking at other opportunities. We've got other things going on. So now it's time management and prioritizing the most important things for the day and the week. That's the challenge going forward. And the goal being, I don't know, a year down the road, 2 years down the road, to set up better systems so you can be less and less involved in that process.
Yeah, it's a great way to put it. Chunking and repositioning this 24 unit has been at least a part-time job in itself, almost a full-time job. But next time it won't be because I'll have learned from it. Like we've said before, the systems are in place. You know what to do going into it. I'm actually repositioning the 2 unit that I live in right now, and there's a construction crew on the first floor redoing that whole apartment, which is why I am in our office, which is also a 39 unit that Bill acquired. How's that project gone?
That's gone pretty well. That's had some interesting challenges too. Every property does, I believe. Managing tenants, it's a 55 plus community, but I believe I would say the average age here is more like 75 or 80. So, there's different challenges with them. They're very easy on the property. The property is in great condition because of that. There's not a lot of activity going on, not a lot of keg parties at this one, but it also brings other challenges. They're all retired or mostly retired, and they just want to talk to us. And we happen to have our office at that property, and it's a challenge to get work done when you have seniors that just want to hang around that front lobby and talk to each other or talk to us or just the normal gossip of the day. But as a whole on that property, I bought that at market value. There was some major operating efficiencies to be had on the expense side, which we took advantage of. And we were able to get 12 or 13% rent growth year one and 8% rent growth year two. So it's checking those boxes on repositioning and creating serious value in a short period of time.
Absolutely. What would you say is the number for how much you need to increase rents in that first 1 to 2 year period? For the end of this episode, I want to give listeners an idea of what to do if they want to reposition multifamily assets. What's the number for that rent growth that you're looking for?
Well, a lot depends on that going in cap rate and the style of asset. Where I consider this a B asset. If it was a C asset, I would, based on that risk profile of a C, I would expect a much higher rent growth potential. But a B asset, it's much more stable. So I didn't have as much of an expectation on that rent growth based on the stability of this property going in. It wasn't, we didn't have, you don't see construction crews here. We're turning over apartments and doing very slight value add stuff. So it's been stable that way. But I like to at least get on any opportunity at least 20% over a 2 year period. It's beautiful to get that 20% year one, and that happens on some of the deals that we've done. But if I'm able to get 10 year one, 10 year two, that's some pretty serious rent growth that's going to outpace inflation or can get you from that 6 cap to an 8 cap in a year or two.
My number's been 30% as I've been looking over new deals and looking over our previous deals. And that's not an arbitrary number. It makes sense when you have to put 25% down normally. And then you have this 5% closing costs on both ends. And if you want to increase the NOI enough to refi out and pay back your investors, if you're using private lenders for that down payment, you need that 30% increase, and the numbers add up. So that's about the number that I've been looking for as a bare minimum for that first couple of years of growth. Are there any other tips that you would give to anyone that wants to reposition multifamily assets?
The only tips that I have is, make sure if you're going to get into it, and I guess it goes back to anything that we're buying, if you have the ability to do a thorough due diligence going into a good deal, that is very, very comfortable. That's the cherry on top, knowing that you have a value add business plan, rent growth business plan that you're going to be able to comfortably execute over a year or two. And you're also able to do the inspection and that thorough due diligence, knowing that any surprise expenses that you didn't see up front, you're able to get on that home inspection part. Whether you're able to retrade or not, that's a whole nother conversation. But you're able to put that into your CapEx underwriting so you can really accurately project that next year or two.
Yeah, we have a full episode on you walking away from, was it 92, 94 units? Because in the due diligence process, you found things you didn't like, and it ruined the deal for you.
Ruined the deal, and that had massive rent growth. That I was super excited about that, but we found estimated probably $750,000 to $1 million in capex on the structural side, and I think it's still penciled out, believe it or not, with that capex. At this point in my journey, it wasn't in my criteria to take on $1 million construction project on a fully occupied complex for a year's period of time. Just wasn't something that excited me.
Yeah, that doesn't sound fun to me either. I know you have multiple projects going on in Florida, and those are all going well. We could talk about that all day. Maybe another podcast episode in the future, just going over your Florida portfolio. Is there anything else that you want to add for this 100th episode that goes over really the business model of what we do every day?
The only thing I'd like to go over, and it's going to tie into the Florida deals, maybe we'll do another episode on that because it answers your question on building systems and processes so we're able to be owners, not operators. My Florida properties, I'm joint venture, general partner, and I'm a valuable member of those teams, and I'm passive. I've set up without having to do formal systems and procedures. My partners have them set up. They're running these projects. I'm able to consult and talk on a weekly, monthly basis how those assets are going. And otherwise, I'm not active at all.
Bill, is the passive life the good life?
Passive's the way to go. I've been, I loved being busy. And that's what brought me to burnout at a certain point. And now I just look at things at a much different perspective. If I'm able to capital stack my portfolio and go from address to address and be as passive as I possibly can on each one, that's the goal.
That sounds like an investor's dream. So we'll see how the listens look like on this episode. If we're getting a lot of play, we'll have to do a second episode going over your Florida portfolio. We've been paying attention to our downloads and listens recently. We've seen massive growth in August, so thank you to everyone listening. We hope to keep that going. The best way to help us do that is supporting the show by liking, subscribing, rating, reviewing on Apple Podcasts, Spotify, YouTube, all of these social media that you can find us under Collecting Real Estate. Thank you for listening all the way to the 100th episode. It's been a good, probably year and a quarter run. We're excited to keep it going.
Absolutely.